Hello, everyone. I'm Professor Harjeet Singh. In this series of lectures, starting today, I will be discussing the topic of managerial economics. Our primary focus will be applying economic principles and analytical tools to help managers make better decisions. Instead of viewing economics as an abstract theory, we will treat it as a practical framework for solving real business problems. Let us begin our journey by outlining the critical concepts we will cover in this session. First, the core premise is to bridge the gap between abstract theory and practical framework. While standard microeconomics explores these concepts in isolation, managerial economics synthesizes them into actionable tools for decision making. Think of it like this. Standard economics gives you the map of the terrain. Managerial economics gives you the compass and teaches you how to navigate. Once we understand the premise, we examine the fundamental economic entity, the firm. The structure of the organization determines how decisions are made, which tools are most effective, and what information is prioritized. Contrast the simple decision-making process within a small, flat structure against the layered, decentralized, or specialized decision chains required in a steep hierarchical structure. One of the most foundational concepts in all economic thinking, and often the hardest for non-economists to master, is opportunity cost. As a manager, you must visualize all costs, not just explicit costs. The cost of choosing option B is not just the resources spent on option B, but also the net benefit you sacrificed by not choosing option A. The graphics you see in the exhibit captures this concept by visualizing the manager at the crossroads. The manager at the crossroads, explicitly showing the sacrificed opportunity cost. Opportunity cost, sacrifice opportunity cost. This arrow shows it's pointing backwards. So this represents the opportunity cost of choosing one option over the other. We introduce the main decision-making rule, marginal analysis. This tool identifies the specific point where we optimize. If we look at the curve, for example, the MB or marginal benefit curve and the MC or marginal cost curve, marginal cost and marginal benefit curve, we must find the intersection point right here, intersection point. We can visualize the optimization decision on the graph, as you can see in the exhibit. The manager should increase production Q, production is Q, output, as long as MB is greater than MC. Stopping at the exact point Q star, that one, Q star, where they intersect. So that is the optimal point. So this is a profit maximization situation where marginal cost is equal to marginal benefit. Once we have established the principles within the firm, you can see this image. You must then visualize the external forces impacting that firm, that is demand and supply in the market. This graph is likely familiar, as you might have seen this before, but we analyze it as a manager's visualization of the dynamic intersections of consumers and producers, supply and demand. The resulting standard graph is a powerful, clean model for visualizing where market pressures converged, forming the classic X pattern. So you see this. This is X style. Like looks like X. So demand and supply they play under the market pressure, and the point where they intersect is the point of equilibrium. Now let's talk about market equilibrium. The next critical concept is when those dynamic forces like demand and supply curves converge into market equilibrium. As a manager, you are zooming in to find the exact point of market maximum stability. This zoom in effect highlights the unique intersection of PE, like a equilibrium price, and QE, that's equilibrium quantity, where the market clears and prices are stable. The stability is visualized by the soft glow, that you can see soft glow at the intersection, pointing directly to the intersection point. Finally, you must be able to visualize when those markets break. The last concept is government price controls, where we visualize the market distortion that results when a market is not allowed to reach its equilibrium. Visualize the resulting shortage, defined by the glowing red line. See the glowing red line here, right here. The ceiling price is lower than the equilibrium price. You can see on the graph how quantity demanded, that's QD, um, quantity demanded far exceeds the quantity supplied. This model allows a manager to predict the resulting market distortion for a specific product, such as rentals. So I hope by this point, actually, you have some good understanding of how economic thinking helps manager make strategic decisions. We can define managerial economics as the application of microeconomic principles and tools to business decision-making problems. We discussed this application briefly in the introduction, contrasting abstract theory with the practical frameworks. But now we zoom in on how that application functions. Microeconomic principles are the foundation, but managerial economics synthesizes those principles into active dashboards. A manager holds the analytical tools that and integrate, uh, interact with and integrate market data, such as supply, demand, as we discussed before, directly with internal operational data like pricing and inventory. This systematic analysis provides the structured tools necessary for answering four foundational managerial questions. Number one, What price should be charged? Number two, how much should be produced? Number three, should we invest in new equipment? Number four, how should we respond to competitors? We visualize this systematic analysis not as a series of random decisions, but as a continuous cycle through all four nodes, which are interconnected by the single coherent process labeled economic analysis. This systematic process of economic analysis ensures that when a company decides to expand production, they must first explicitly analyze all four critical factors provided in the text. That is market demand, production costs, expected profits, and competitive responses. Managerial economics provides the structure to do this predictably and strategically. Now, let's talk about firm. What is a firm? We can define a firm simply: it is an organization that converts inputs into outputs. This input to output conversion process is the fundamental activity of any business entity. When we visualize this, we must include the five input categories provided. Those are: number one, labor. Labor includes the people, um, and the second one is capital. Capital is the money. And number three is raw materials like crates and barrels. Number four is technology like gears, circuit boards. Number five is managerial expertise. So all these comprise what goes in, right? So we see that all five ingredients converge into a central arrow labeled conversion process with the dynamic light energy resulting in two outputs. First one is goods. Goods, you see the product box here, right here. And second one is services. You see the handshake here. Firms in most cases must convert these inputs to maximize profit, but the legal form of the organization impacts its risks, financing, and governance. We can summarize the four common legal forms by comparing their structure, advantages, and disadvantages directly on the large screen. So this clean, you can see this. I mean, these um, these four common legal forms that they can be compared based on their structure, based on their benefits and disadvantages, and let's look at those. So you can see this exhibit here that shows sole proprietorship now and partnership, limited liability company, LLC, and corporation. So sole proprietorship is a single individual owner, okay? And partnership, two or more owners. Limited liability company, LLC, provides limited liability with the simpler taxation. And corporation is owned by the shareholders and managed by professional managers. Okay, they have their own advantages and disadvantages, as you can see in the exhibit. So we can see there's a structure referencing the same hierarchical or flat decision-making structure from the introduction we discussed before. Visualizing the advantages means advantages include perpetual life, like a limited liability, and disadvantages such as unlimited liability or double taxation. As you can see this in this exhibit. The key assumption in managerial economics is that firms maximize profit. The first step is to calculate total revenue, abbreviated as TR. TR is equal to price times quantity. We start with a simple calculation. For example, $20 multiplied by 1,000 is equal to $20,000, as you can see in the green box in the exhibit. The exhibit also shows the simple base revenue bar with a stacked multi-segment bar labeled adjusted TR, which visualizes the complex descending adjustments listed in the text. The discounts, like returns, allowances, and rebates. The resulting target for the manager is the final smaller net total revenue. It is critical to distinguish between accounting costs and opportunity costs because economists and accountants measure costs differently. Accounting costs are the explicit costs recorded in financial statements. For example, salaries, rent, utilities, equipment purchases, etc. Economists, however, focus on opportunity cost, which represents the value of the best alternative use of a resource. Imagine an entrepreneur who owns a building and uses it to run their own business. From an accounting perspective, the cost appears to be zero. However, from an economic perspective, we must stack both explicit and implicit costs. The resulting total economic cost, you can see the right panel of the exhibit, includes the same explicit costs plus a large green section titled implicit cost. Implicit cost or opportunity cost, which explicitly calls out foregone building rent and foregone owner's salary. This broader economic perspective, guided by the compass, leads to better managerial decision making. Another cost concept related to cost is sunk cost. Sunk costs are the costs that have already been incurred and cannot be recovered. These are history and should be ignored when making future decisions. Managers should focus only on the costs and benefits that will occur going forward. This is visual by comparing two paths, as you can see in the exhibit. The pitfall, which is considered sunk cost path in red, uh, which points to icons representing previously acquired resources with a large red X over them, indicating the incorrect decision rule. The optimal decision, that is to ignore sunk costs. The path green leads to green glowing go no go matrix labeled evaluate future cost benefits only. We have now introduced the powerful tool used by managers that is called marginal analysis. Marginal analysis compares the marginal benefit or MB or the additional benefit of making an action with the marginal cost, also called MC, which is the additional cost associated with that action. The basic decision rule is simple. If MB is greater than MC, take the action. If MB is less than MC, do not take the action. Managers must continue expanding an activity, such as producing something, until MB is equal to MC, which is known as the profit maximizing rule. Remember that. We can now visualize the optimization rule on the graph below. You see this exhibit in the exhibit, which is a high fidelity replication of the curves and intersection. That's a Q star. And it's this shows that at the intersection of the two curves. New glowing auras clarify the logic. A green glowing aura expands up to Q star. This is labeled as profit increasing, that is MB is greater than MC. A red aura, on the other hand, starts after Q star. It's labeled as profit decreasing, that is MB is less than MC. The summary text at the bottom is clearly indicates that is clear. It indicates clearly that stop activity when MB is equal to MC. Marginal thinking is the central to optimal managerial decision making. Make a note of that. Again, I'm going to repeat again. So marginal thinking is central to optimal managerial decision making. Once we understand the internal firm principles such as profit, sunk cost, marginal analysis optimization, etc., we must turn to the external market environment and the demand and supply factors that impact it. To understand how markets operate, economists analyze shifters and how they interact to reach equilibrium. The following exhibit that you can see separates the shifters into two panels using the curve colors established like a blue D or orange S. Icons show increase in D shifters, for example, higher income, more buyers, substitute price rises. Moving the blue D curve on the left panel, you can see that. Icons show increase in S shifters, for example, lower production costs, improved technology, more suppliers. Moving the orange S curve, right panel, This provides a structured tool to analyze why the market forces are not static. Sometimes governments intervene in markets through price controls. The visual that you see summarizes the two forms. Number one, price ceiling. Price ceiling sets the maximum legal price, such as rent control, um, drawn. You can see in the exhibit, this left panel of exhibit. Um, that shows the PE that's creating a shortage, excess demand, with the specific red aura replicating. This see the shortage that we discussed this before also. That shows because this is the red line right below the equilibrium point. The text below, it shows that text in the bottom of the exhibit, which is ceilings create shortages, uh, floors create surpluses. So while we are talking about the ceiling, so ceilings create shortages. You can see that the left hand side of the exhibit, it shows the price ceiling. You can see the red color, the glowing portion shows the shortage. And how about price floor? Price floor is sets the minimum legal price, such as the minimum wages, drawn above PE. This is above PE, basically equilibrium point. Like a shortage is below the equilibrium point, but surplus or a price floor is above it. You can see the blue glowing, area. This creates a surplus. Excess supply that leads to unemployment because the wages increase, unemployment increases. So with the specific blue, or I can see that in the exhibit. Again, to summarize this whole thing, the takeaway is that ceilings create shortages and floors create surpluses. So understanding these policies is very important because government regulations can significantly influence market outcomes. Finally, managers can use demand and supply analysis to predict market changes and guide business strategy. By understanding these economic relationships, managers can anticipate market trends and make more informed strategic decisions. Thank you for tuning in. I see you in next session. Thank you.